Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinar, like all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. One last look at that disclaimer. And let's welcome Dimitri Pargamonic to the stage. Hey, D.
Good morning, Will. How are you?
Good. What are we going to be looking at today?
Yeah, let me share my screen.
Iron Condors, maybe?
Yeah, we're going to take a look at a benchmark for tracking the cost of an Iron Condor strategy. And this will continue on our conversations with looking at benchmarks for different option strategies. Today we'll cover the Iron Condor, and I'm going to go to SPY in our example. So type in the stock symbol in the search. On the left-hand side, you have a menu here. Click on Options, and then scroll down to Strategy Benchmarks. Click on that, and you come to this page. Let's close the menu to the side to expand our screen. You come to this page and you have different strategy benchmark indexes. And here you see these tabs that indicate which strategy. I'm going to scroll to the right and we're going to click on Iron Butterfly. And what we're doing here is looking at the option strategy of an Iron Butterfly, and we want to see, well, what is the cost of that strategy, the value of an Iron Butterfly, and compare it to historical values, so we could determine if it's on the higher range or lower range of history. But before we do that, let's take a look at what this Iron Butterfly strategy is in the first place. And as you could see here, there's this sample payout diagram of what it looks like at expiration. And of course, you could do the flip side of this. But for this particular example diagram, this is what it looks like. You're looking at selling a call with a strike price of B, which is right where the spot price is, selling a put with a strike price of B. So you're selling an at-the-money straddle, and then you're buying an out-of-the-money call, strike C, and you're buying an out-of-the-money put, strike A. And what this does is, if you're selling a straddle, and then you buy the wings, the outside wings, this protects you from unlimited losses to the upside or to the downside. So you're mitigating your potential risk by buying those the outside strikes of the call and the put. And if you do this side of the strategy, your sweet spot is right at the strike B. At expiration, you want all the options to expire worthless. And if you do that, you'll keep the credit that you receive for selling this strategy. Okay. The reverse side is you would want the stock to move away from it and end up above strike C or A. Okay. So let's now take a look at what this strategy is values right now. And again, this is looking from the side of selling the straddle, buying the wings. And to benchmark it, okay, we need a couple things, because we want to compare what the price of the straddle or this strategy is now relative to where it typically is priced. So One thing is we need to create a constant maturity, because we can't compare, yesterday this iron butterfly had 30 days to expiration, tomorrow 29 days and 28 days and then so forth. Well, because the time to expiration matters, right? Because there's time premium involved, we need a constant maturity. So here we create a 30-day constant maturity option using similar formula to the VIX. But we also have to define the strikes, the legs, because you could have a butterfly with, so we define that at the monies, but then you have these strikes to the downside and strikes to the upside. But that could be 1% away, 5% away, 10% away. We need to define it, and so we know what we're tracking. In this instance, we're looking at selling the at-the-money call, selling the at-the-money put, buying a call 5% out of the money, so 5% above that at-the-money, and then buying a put 5% below that at-the-money. Okay, so that's what we're looking at. An Iron Condor with the wings 5% away. And now we create those synthetic options based on the observed data and options surrounding it. And here we see that there is a credit currently of 3.1% up spot price. So here we kind of normalized it so we could compare it, over time and compare it across assets. And what this means is that if we take 3.1% of spot price, that is the cost of the Iron Condor. You're receiving a credit because you're selling that, the money's buying the wings. So how does that compare to history? Well, if we look at the 52-week average, it looks like the credit was 2.4%. That means right now there's more credit. People are willing to pay higher premium for this strategy, and people selling and demand a higher premium, 3.1% versus 2.4. And you could see here, this is a graph of the history. So this dotted line, that's the average of all the observations. And this is how the cost or the value of this strategy fluctuated around the average in the last 52 weeks. Okay. And the market is signaling that, as you could see here, this strategy, it's not directional, it's a volatility type of strategy. It's a strategy that's based on either large stock movement or lack of large stock movement. If your sweet spot is right at the money and you're doing this strategy, then you hope that there's no volatility and the stock just sits here or moves around a little bit around there, but sits there. If you're doing the flip side, buying the straddle, selling the wings, you want the stock to move away from the current spot price. You want it to go, at least 5% up or 5% down, because that's where you're going to maximize your gains. And what this is saying is the market is indicating that it perceives volatility from this point to be more than usual, more than normal. Right? People are willing to pay you more to put on the strategy, and traders are requiring higher premium to sell the strategy, 3.1% versus 2.4%. And if your outlook is, well, in the next 30 days, maybe we'll move around, but I think that this is my sweet spot here. I think that this is where we're going to end up. Well, then you could look at this as an opportunity, because now you're getting even a higher, more credit. You're getting paid more from the markets to take on that risk. Okay, so there's a bigger reward if you're correct. And on the flip side, if you're looking to bet on the market movement, that it'll move away from here, you could see how much more it will cost you relative to history and where the market is pricing things. Now that we have this benchmark, we could also look at further out maturities. Let's, for example, come down to 60 days. Here we see there's a credit of 3.7% versus historical average of 3%. Going out 90 days, you have credit of 3.9% versus a historical average of 3.4%. And if you go out 120 days, getting credit of 4.1% versus a historical average of 3.7%, which makes sense because the further you go out in time, the bigger chance that the stock will move away, right? That there will be volatility and that it will move away. So the credit that you would receive, or the debit you would pay to put on that strategy, would increase. Okay. And here you get a sense of what you currently would receive or have to pay relative to history. Now, having this in front of us, we could also now compare it to cross assets to see because now we kind of normalize this to a 5%, right? A 5% iron butterfly. Well, what if we compared it to other iron butterflies that have 30 days to go with a 5% out of the money wins? And if you believe the entire market, let's say it goes to 1 beta, and the entire market might, go up a lot or down a lot, and they're all going to correlate. Because right now we're kind of in this market regime where stocks are moving a lot together because of the systemic or market related news. Let's say that the market right now is influenced highly by tariffs. Well, that's the tariffs. That news is not firm specific. It's impacting the movement of the entire market. So if things go one way, the entire market will either move down or it will move up. So given that, we may want to look at where when in that perspective, it might not matter if it's SPY or QQQ or IWM. If everything just kind of moves with 1 beta, we could look at QQQ. If we think that the market will sit here, maybe we receive more credit for the QQQ. If we think it's going to move a lot, let's say we think it's going to move up 5% or down 5%, at least, well, maybe the cost of that iron butterfly may be less, right? Because we're on a relative basis than the SPY. So let's take a look at that. I'm going to type in QQQ. And now it took us to the QQQ iron butterfly. So here we see it is 3.4% versus a historical average of 2.9. So what was it? 3.4 versus, I already forgot. What was it on that? It's 3.1%. So it will cost you, if you're looking at movement, it will cost you more in a QQQ, maybe because it is more volatile. But if you believe that it moves to 1 beta, then it will cost you less in the SPY than it would in the QQQ. If you're looking at lack of movement and the entire market might just sit here, well, you're getting more reward in the QQQ versus the SPY. So think of it this way, and then we could look at the historical averages. If right now we're looking at 3.4 versus 3.1. Historically, it was 2.4 versus, let's take a look, 2.9. So close, differential. So here, what we did was we looked at the benchmark, one, to compare the current pricing relative to the historical range and historical averages. We were able to compare those benchmarks as we move out further in time. We looked at it from the perspective of either potential opportunities or what the market is signaling. Is the market signaling that it's expecting more volatility than normal, less volatility than normal? And we also looked at it cross asset to compare, similar products and what the differences are between them, and the differences on a relative basis historically between them. So Will, I'm going to stop right there. I think I, covered, that particular benchmark at this point. Yeah, so I'm not sure if I have Will anymore.
Yeah, no, I'm here. I'm here.
Okay.
Yeah, my mute was on. Sorry about that.
Oh, yeah.
Nice comment from Cincy, who used the earnings screener every Sunday to run a report. People were talking about they have some Iron Condors on this week. So people in the chat were talking about it. But great job, D. That was a great analysis using the Iron Condor benchmark. Great job, as always. Thanks for bringing this information to the community.
Yep. Thanks, everyone, for joining. Stay safe out there. We hope to see you guys tomorrow.
Yeah, great job, my friend. Everyone, remember to like us, follow us, give us some thumbs up. Everyone have a great, safe start to the trading week, and we'll see you tomorrow. Thanks, everybody.
Thanks, everyone. Bye.